Hello everyone, and thank you very much for joining us for today's webinar on using tax returns for global cash flow with multiple pass-through entities. My name is Billy Burnett, and I'll be the host of today's presentation. Before we begin, just a couple of housekeeping items to go through. First, all attendees are in listen-only mode, so there's no need to worry about any background noise on your end. And since you are in listen-only mode, in order to ask any questions, you can do so through the GoToWebinar panel on your screen. Just type those in throughout today's presentation, and we will do our best to address those during the call, as well as following up afterward with any we do not get to address during the presentation. Third, we will have a variety of interactive polls throughout today's presentation, and we certainly encourage and appreciate your participation in those poll questions. And finally, we will have a recording of today's presentation available, as well as presentation slides. So those will be emailed out following today's presentation. And you should also see a link that was chatted out by me in the GoToWebinar panel to access those handouts and materials. So next, I'd like to continue on to about SageWorks. So SageWorks is a financial information company providing credit and risk management solutions to financial institutions. We currently work with thousands of financial institutions and accounting firms across North America, and we were recently named to a variety of different awards, including the North Carolina Technology Award for Excellence in Customer Service. So this time I'd like to go ahead and introduce today's presenter, Linda Keith. Linda Keith is a fantastic resource, and we thoroughly enjoy partnering with her on these educational webinars. She provides credit training to financial institutions throughout the country with a focus on tax return analysis and financial statement analysis. She's an expert in business and ag lending, lending to the wealthy, and other complex borrowers. And she does a variety of training formats, both in person and virtual, and also through a variety of videos and other resources as well. And this is our third webinar that we've partnered with Linda Keith, and they're always among the most popular and also the most forwarded among institutions and others. So we're really excited to have her with us today. Also want to introduce on the call today Mr. Rick Daly. Rick is a credit analysis consultant here at SageWorks and an expert on the SageWorks credit analysis platform. So as you are going through, for the customers that are on this call of SageWorks credit analysis, feel free to chat in those questions as well, and we'll be answering those either electronically through GoToWebinar or also verbally on the call should we have time to do so. So encourage all questions, regardless of the nature of them, throughout today's call. Number of experts on here, so encourage you to take advantage of that. So with that said, would like to go ahead and turn it over to Linda Keith to kick off today's presentation. Linda?
Hey, thank you, Billy. I'm happy to be here again with my SageWorks friends. Let me tell you what my plan is for today. I'm planning for the people on this call to be able to compare notes with others through polls. So what we're going to find is there's quite a variety in the guidelines and the practices when it comes to these pass-throughs. And so I felt like there would be some benefit for you to actually be able to compare what you're doing to others. So we'll use polls for that purpose. You'll be able to consider your guidelines, and you're actually going to take back a list of my guideline questions so that if you are the person who is in charge of guidelines, you can consider whether you've got adequate and clearly communicated guidelines in those areas. If you're the one who needs to implement guidelines because you are the lender or the analyst, you'll be able to look at that list and be able to answer the question, am I clear on our guidelines? I will do some walkthroughs of cash flow scenarios, not in a training format because this is just a 1-hour webinar, but more that overview, take you along with you and show you what I do. And then we'll have some opportunity to ask questions. Now, I've got a robust number of slides for a webinar, but what I'm counting on is that if you go, as we go through, there's something that you need to pay more attention to, or you need to sort of shift into that training mode where you can grab your calculator and calculate things and see where the numbers are coming from. That's why we have the recording. And you'll be able to access that recording if you find that level of detail would be helpful to you, and use the pause and play so that you can actually turn this overview into a bit more of a training situation. So what I'd like you to start with is to go to that chat section, the questions section. Would you please chat in, what are your hot buttons when it comes to global cash flow related to pass-through entities? And I'm going to watch that question section to be sure that what I plan to do in the next hour is a good fit for you. So in the questions or chat, just start typing in, what are your hot buttons? All right. Should we ignore E2 completely? Matt, love the question. What is actual cash? Absolutely plan to do that. Section 179. Oh, Jeannie, hi. I know you from somewhere else, I know. Section 179, I don't specifically plan to hit that, so when it fits well, please ask a question about it. And capital gains. And again, as Billy pointed out, you can ask absolutely any question at any point, even if it's not completely on target with what I'm saying, because between me and Rick at SageWorks, we're going to follow up on those questions. Let's see what else we have. Capital gains, okay. In-kind contributions, accuracy, love that, Skip. What entities to include, absolutely. What happens when you don't get K1s? Ben, you ask again, but we'll talk about that. Subchapter S, or sub-S distributions, difference between income and cash flow. All right, boy, it sure sounds like what I have planned is going to fit. Guaranteed payments, I definitely, Tricia, am going to talk extra about those because those are not guaranteed, just to say. Accrual to cash, I don't plan to specifically talk about that, but ask the question anyway, and possibly we'll have time for that. What is actual cash inflows from? Schedule E income should be focusing on distributions or cash from the entities, absolutely. Okay, I think we're on track, so thank you for that, and again, we've captured that chat stream, so I'll be able to look back at that, and for those of you who have asked questions that aren't completely what I plan to do, I will promise to follow up with you. So here are mine. Double counting by mixing up taxable income, actual cash flow, and cash flow available, which I guess would be called triple counting, not double counting. We're interested in not double counting, and frankly, we need to be interested in not triple counting. Using 1040 Schedule E page 2 figures for pass-through entities. That's a problem, and you'll know why by the time we are done. And then here's another one. Using a formulaic, numbers-only approach without adding judgment. Now, that's certainly where our junior lenders start, because that's how you learn in the first place. But boy, we have to help them as quickly as possible understand what judgment should we be using and how do you look at these things in more than just a numbers-only approach. So you'll be hearing my take on those things as we go along. So it sounds like we're in sync, and we have a way for you to get extra information if you need it. All right, so my first question always is, who is your borrower? Because global cash flow is a little different when you're lending to a business and you're pulling in all the guarantors, or if you're lending to an individual and you're pulling in all the entities they have an involvement with. So we're going to actually look at both of those as we go through today. And here is the scenario I'm going to provide for you. There is a company, B&J Floors. We have a 67% owner, Ben, a 25% owner, Jan, and a 8% owner, Zach. And so we'll use this scenario to see, and it turns out Jan owns some other pass-through entities as well. So we're going to use this scenario and sort of introduce and walk through the different possibilities with regards to pulling cash flow at an entity level, at an owner level, and at a global level. In order to be sure that I'm on track with what we want to cover here, I'm going to ask some poll questions. So Billy, if you pull up the first poll, this is just about what kind of lending you do. And you can select all that applied, so feel free to select more than one if you want to. And let's see. Getting close is very helpful if you do come in on these polls, because it does change what I talk about. And so Billy, go ahead and let's show the results. And boy, most of you business, well actually business, some ag lending, hi guys, and then a smattering of the other as well. So we're covering all bases, and what you're going to find is You may be a business lender, but sometimes you're looking for the very same thing that the consumer lenders are looking for. So that's real helpful. Next, another poll question. This will help me again to make sure that I hit the right bases for you. So if you'd open that poll, this is about what you do. Who do I have on the call? And I'm watching you come in. This is real interesting and very helpful. Very helpful. It will definitely change how we're looking at things. Go ahead and show the results. Yeah, so loan officer or business development officer, 10%. 71% of you are analysts or underwriters who actually have to come up with the numbers and have to document it in a way that it will pass muster with everybody. I've got 9% of you are in a management position, which means you have responsibility for those guidelines being accurate and clearly communicated, and also 3% senior lender, and 7% something else. Wow, I wonder what they do, but I'm not going to take time to ask. All right, so again, here is our scenario. And so my first question that's going to be helping you compare what your company does to others is this. If you were a business lender to B&J Floors and this is the percentage ownership of the individuals, then before I tell you what I would do, I'd like you to tell me what you would do. And so another poll question, and here's another suggestion. For those of you especially who have any responsibility for guidelines or are going to pass this information on, if you have your handouts, go ahead and make a note of the responses that we're getting, especially when we get to guideline questions. It'll be very interesting to see if you are in sync with most of the other folks. So I am looking at the responses. It varies. It varies. This is very interesting to me. All right, let's go ahead and show the results, Billy. We're all going for Ben. Most of you are also going for Jan, not everybody. Most of you are not going to make an 8% owner guarantee, but 30% of you are going to go for everybody. And then a few of you, it depends on something else. Well, let me tell you my take. I would definitely go for Ben, of course. He's a 67% owner. You can go ahead and close that poll, Billy. He's a 67% owner, so yeah, I'm interested in him, and probably in Jan. She's a 25% owner. Some of you have a percentage calculation that says if it's 20% or more or 25% or more, you want that person as your guarantor. But that's a question. And for some of you, if Ben's really strong, if B&J Floors is really strong and Ben is really strong, that might be part of it too, not just percentage ownership, but how strong is that guarantor. And then while many of you wouldn't include Zach, some of you are going to include everybody. And frankly, you could have a situation where Ben's not all that strong, neither is Jan. Oh, Zach is the guy that has the net worth and the liquidity to back this up. This could be, for example, a family business where Zach is actually dad, although he doesn't look that old, and he's the one with the net worth. He's the one with the backup. So I don't know the answer for that one, but I'm going to, I would definitely go for Ben and Jan and possibly Zach, depending on your guidelines. And you could see from that poll that it does vary. So here's another guideline question. On a business loan, what owners are required to guarantee? Is that clear to you? Has it been clearly communicated? Are you sure about the answer? And are there variations because of other things besides just percentage ownership? Now let's look at the tax returns that we're going to have to get. We're definitely going to get the S Corp for B&J Floors, of course, and we're going to get the 1040 for Ben and the 1040 for Jan. So let's assume our guideline is we're picking up those two guarantors. Now that's fine, but when we start looking at some of those tax returns, we've got Ben's, and I'll just tell you, Ben's pretty straightforward. He and his wife have wages. They don't have a whole bunch of other stuff going on, so that one's easy. But when we get into Jan's, not only does she own 25% of B&J Floors, but she owns 100% of her medical practice. So you could maybe get the full S Corp And the reason for that is it is such an important part of her income. If her income is important enough to guarantee the B&J floors, then everything that supports her income is pretty important, and 100% owned S-Corp does. But you're not lending to Odds and Ends Medical Clinic. You're lending to B&J floors. So maybe you'd say, Linda, they're not obligated on the loan. I can't make them give her more money. So you might believe that the K1 is a better indicator. And the K1 will tell you what she did take. We will look at one later. I will make sure you know where to get those numbers. I'm not sure I like either of those answers. I like the K1 because it is what she did take, but golly, if the company can't support what she's been taking from operations, I'm not sure we want to count on it if it's a big part of the support for the B&J Floors loan. On the other hand, I get your drift. If they're not paying her more than that, then maybe you want the lower. So I actually would probably come in right here with both. I might be willing to do the K1, but I definitely want to know that the S-Corp can afford it. Some of you I know have this idea that you're going to do the more conservative. You know, I'll do the lesser of, or I'll do the K1 as long as, you know, it is supported. And if they're paying her less, I want to use the lower number. But here's what you've just done. You have now used a lower number for someone who happens to be somewhat frugal, doesn't have to take every penny out of the company, maybe has some expansion plans so that they can limit what they're taking. Wouldn't it be unfortunate if you were able to make a loan to someone who takes absolutely every penny out of the company and leaves it in trouble? Oh, but you know, you can use theirs because you're looking at actual cash flow. But you couldn't lend to someone who's just been frugal, didn't need it before, so didn't take as much, and now they want a personal loan or they want to guarantee another business loan, and they need the higher amount that they had complete access to. You might liken this to a Schedule C. If her Odds and Ends Medical Clinic had been a one-owner LLC, for example, filing a Schedule C, you would be using all the cash flow generated by the company, and you wouldn't even ask the question, gee, what check do you write from your Schedule C filing entity? It's just that it's because it's a different entity that it comes up. So another poll. Assume you're lending to B&J Floors to require a guarantee from Jan. Ignoring what I just said, what is your understanding of what your guidelines right now would require? She's 100% owner, but you're not lending to her company. Let's see what we've got. And I'm watching these numbers, and I can tell you ahead of time, we're not consistent on this call, and that is my experience. When I do training internally for companies, I learn their guidelines, and they do vary. They definitely vary. So we're almost at the point where we'll go ahead. Let's show that poll results, Billy. So we've got 53% are with me. You're going for both of them. I did require a single answer, so I sort of made you decide. 29%, you're just fine with, you want the full S-Corp? Let's see, no. 29% is K1. Only 5% would only get Odds and Ends. And then I've got 12% of you are saying it depends, might go either way. And I understand that. I think the it depends answer is often the right answer. But if that is the answer, then you've got to have enough guidance with your guidelines so that lenders and analysts know what would make it go either way. And especially if you've ever noticed that lenders and analysts sometimes are sort of at loggerheads. The lenders say, oh, come on, let's do this deal. And the analysts saying, I don't think we can do this. When guidelines are fuzzy, it makes for a difficult situation between the lenders and the analysts or underwriters, in my opinion. All right, go ahead and close that poll, if you will, Billy. So here is one of your guidelines. Guideline questions. If a guarantor's pass-through entity is not obligated on the loan, do we require the full return? And as you can see on the poll, there's a real variety of answers to that. You need to know what yours are. So here we are so far. And then as we continue to look at Jan's 1040, well, she's married to Dan, and Dan, her husband, owns 90% of Valley Vineyards LLC. So now we got a whole other potential set of tax returns. If it was 100% owned LLC, they'd actually be filing right in Schedule C or Schedule F in the tax return. But it's 90% owner LLC. There's another entity, probably a 1065, same set of questions that we had before. Except now we have even another question. Is it possible that you'll ask Jan to guarantee, but you'll only use her share of their personal income because Dan's not signing? So that's a variation on a guideline. When they're married, do you have to use the other person's cash flow? Oh, and I forgot to tell you that in addition to this, Dan owns 10% of a donut shop, which is an S Corp. So we've got another K1 potentially in the mix. So let's weigh in on this one. Poll question number 5, Billy. You're lending to B&J Floors, requiring a guarantee from Jan, who is married to Dan. What additional returns do you routinely use? And again, go ahead and weigh in so that we can be comparing our guidelines to each other. I might point out that some of you don't do business lending, some of you do commercial real estate, some of you do C&I, some of you do small business lending, some of you do ag lending. So some of the variations between you and your other colleagues may be the type of lending you typically do. Billy, let's go ahead and close that poll and show the answer. 57% said none of these choices. If you said none of these choices, would you please chat into the chat box what you would require? The biggest chunk said the K1s, but right behind you was Vineyard's full 1065 because he's a 90% owner, and the K1 from both. So I'm going to watch the chats here and see if you could put into the questions or chat. So I think you might need to close the poll, Billy. If it's none of these choices, then what is it? I'll give you a second to type something in. I'm not seeing it coming in, so it may be that you just don't want to tell me. That's okay too, but you can see that somebody's got to make a decision here on the guidelines. All right, so this is just a visual for us to get our heads wrapped around it, but this isn't what I would put in my files. What I'd put in my files is probably something more like this. So I will always, when I have a complex borrower, I'll pretty much do a graph. I'll put it in the files, especially once I got to Dan, found out she had a bunch of things going on. I'll graph it out to figure out who's my borrower and then who else do I need to be concerned with. And once I have the graph done, then I can start deciding which returns do I want. So if I decide I don't need Zach because he's only 8% and I don't need Dan because he's not guaranteeing, then now I know what tax returns I need to ask for and from whom. But your other options, you could have Zach's 1040 in the mix. You could be requiring Dan Valley Vineyard because it's such a big percentage ownership, and you also could be requiring the donut shop. And if you did, now we're talking 7 returns to do one loan to B&J Floors. That's how this gets complicated, and it's why I'm here with you and you are here with me to be sure that we're looking at the right things. Now, I know I've got some personal lenders on the phone, or some of you who do business and personal lending. So just in case you were thinking, boy, I'm so glad I'm not a business lender because look at the mess they're in. Well, hello. If you're doing a personal loan to Jan and Dan, then certainly you have their 1040, and you have potentially additional tax returns from all 4 of those other entities. That's 5 returns. So our borrowers who are business owners, who are real estate developers, who are ag farm operators, who are wealthy, you are ending up with a stack of tax returns. And I'll tell you, one of the things I do is I use the 1040 just as the roadmap, because when you get to Schedule E, page 2, what it is good for is the list of other entities. That's what I like about it. That's about all I like about it, but that's what I like about it. And we have, by the way, in my resources, we have an online module called Green Lego 6 Ends and a map to tax return analysis that is completely free. So if you want that, just chat in. I'll make sure you get it. There's other resources too, but I hadn't thought about that one until just this very minute. So 2 more guidelines. When doing a personal loan, at what percentage ownership do you need full returns? And also, when doing a personal loan, do you consider something other than percentage ownership, like impact on income or risk. So I want to pause and see if at this point we have any specific questions just on which tax returns to require. I'm okay if we don't, but if we did have one or two, I could take it right now, or we will have time for questions at the end. And then finally, of course, if you have any other questions in here that I don't get to or don't spot as we go along, I definitely will get that information from SageWorks at the end for those that are not just their software specific. All right, so what you actually know on questions on which tax returns to require is I don't know the answer for you because it is a guideline question. But as we go through, I definitely will be looking at more. I'm looking to see, yeah, I can't tell in these questions whether they just came in or not, Billy, so you'll have to let me know if we have any questions on this issue. Let's move on with this next piece. It all starts with the entity return. Income passes through to the owner. So let me give you a quick visual of how these tax returns are functioning. We have a 1065 tax return. I'll show you the 1120S in a minute. 1065 filed by multi-owner LLCs as well as by general partnerships and by limited partnerships. It's information only. This entity doesn't pay taxes, but it does kick out a K-1 for each owner who then can pay taxes themselves. We call those pass-throughs, or another word for that is allocations, but those numbers going into the 1040 from a 1065 or an 1120S are not cash flow, ever. If it says from a K-1, whether it's on Schedule E, page 2, or the capital gains page, or any other page, if it says from a K-1, the Schedule B interest income, it's not cash flow. Let me give you one example, though, of why it is that we have so many numbers landing on this 1040 all over the place that you're supposed to ignore if you're looking to the 1040 for cash flow. Just one example. The net capital loss limitation of $3,000, which I think many of you are familiar with, that's a personal limit, not an entity limit. I don't get to have $3,000 losses from this LLC and that S Corp and my own tax return. So clearly, all of the capital gains and losses have to come on to D so I can even see where I am on this limit. Another example, I don't want to pay Social Security tax on capital gains or interest. I have to pay it on business income if I'm active in that business, so that number has to be coming through by itself. So that is why there's so many numbers landing in so many places, and it's why you have to be cautious. You know, I do training on tax return analysis, and what a lot of lenders do is they'll just go right down the front of the 1040. They'll see a Schedule B number, and they'll throw it on as interest income without even looking to see on Schedule B if some of it is from a K-1. If it is, I don't count it at the 1040 level. I'll count it if it's significant when I do the 1065 or the 1120S because it's entity cash flow. It's not owner cash flow. So lots of different choices. If what you care about is actual cash flow to the partner, which I do know I've got a few people on this call who actually are following along in my handout, so this is slide 31. If you're going for actual cash flow to the partner, then you need the K-1. I put the calculation on the screen, guaranteed payments plus distributions minus capital contributed. I'm going to talk about guaranteed payments in just a moment and clear that up for you. Frankly, they also could be getting rents, loans, or loan repayments. The rents themselves would show up as income on their 1040. Loans or loan repayments, well, loan repayments would show up at least part of it on Schedule B. So there will be clues in the 1040 to these other things. But that's what they're actually getting. If you had the checkbook, that's the number. So if that's what you care about because they're a low percentage owner, or if that's what you care about because the entity is not guaranteed on a loan to another entity owned by that owner, then K-1's what you need, period. But if you want to know cash flow available to the partner, maybe because they're a high percentage owner, or maybe because you want to at least be sure that what you are giving them credit for on their K-1 is sustainable from operations, you need the full 1065. Plus, you need to give her credit for her guaranteed payments. Again, explained a little bit more in detail later. So that's what it looks like. Just step back for a moment and take a look. That's what it looks like. By the way, this diagram assumes that the partner is a 1040 filer. Of course, the partner could be another partnership, couldn't it? Or an S-corp or some other entity. But when you see something from a K1 into the next return, and you're looking at that next return, the K1 pass-throughs are not cash. They're not cash paid. They're not cash available. To me, they're helpful for the roadmap, and that's about it. Let me show you the S-corp. It's very similar, except that S-corp shareholders also get paid wages instead of guaranteed payments. So same idea. If you want actual cash flow, you do need K1. We use distributions. You can also consider rents, loans, repayments to the owners, and I will talk a little bit more about how you decide that here in a bit. Cash flow available to the shareholder. I do know that I misspelled shareholder. I just like to put something in every slide deck so you know I really did this just for you. You need their share of the S-corp, cash flow, and of course the wages that they are getting, because the wages were deducted at the S-corp. They are covered in her personal tax return, so you won't be double counting on wages, but you would be double counting with that number from the back of E. This is one of those deals, again, where this is an overview, and if you're thinking, wow, she just went a little bit too fast for me, that's what the recording is for, is so you can slow down. And for those of you looking at the handout, in the recording, I've used the animation as I'm talking, so you actually can see exactly what piece I'm talking about as we go along. So let me just wrap this piece up before we work our way into some of the tax forms. First of all, so if you're doing an entity level analysis of a pass-through for a business loan, so let's say we're just looking at B&J Floors, how is it doing? Then your goal is cash flow available to pay debt, probably using either a debt coverage ratio or maybe looking at their margin or their deficit. Do they meet our criteria? The guideline or procedure questions that you need to understand or create is, what is our guideline for DCR or margin? And is it flexible at all? Sometimes you want a certain deadline for or guideline for debt coverage ratio, but if they're really highly liquid, if the loan to value is really low, if the collateral is really solid, that might mitigate a DCR that's a little bit low. Maybe. Depends on your guidelines. And also, do we even worry about a deficit or low DCR at the entity level if we know we're going global? Now, if you're doing a global analysis of a pass-through for a business loan, we're going to pull together not only B&J Floors, but now we're going to pull in whichever of these individuals our guidelines require. We're still going for the same thing, cash flow available to pay debt using probably a DCR or a margin deficit, but at a global level, meaning we're including all the income from all the guarantors and the business, but also all the debt from all the guarantors and the business to see whether they have a margin or a deficit and what their debt coverage ratio is. Now this time we add some more questions. Who will guarantee? And if you don't require everybody to guarantee, how do you get an accurate debt coverage ratio? That's a problem. And in fact, one of the pre-webinar questions that came in was about that very thing. I'm going to cover that when we actually look at some tax returns. And then what if a guarantor is an owner in another pass-through? Am I supposed to do something about that? So these two slides, which are, by the way, a little text heavy for me for a webinar, but because I know many of you are going to download the handouts and use that as a continuing resource, that's really why I've put the level of detail and debt in the text here for you. Finally, for DCR analysis, what will I use for family living expense? Great question. I will entertain that one as well. That's a big variation, and I'm afraid that often the question is, what member will make my loan work? So actually, you can raise your hands if you want to, and I would like you to do that. Would you please raise your hand if you ever had anybody in your company use the what do I need to qualify the borrower for determining living expenses? Have you ever heard of that one before? I'm going to watch and see if anybody else is with you. Oh, hi, Carrie. I see some people that I do know. Good to see you on the call. So I actually expected more hands raised, which may mean that you know your colleagues are on the call too and you don't want to admit to it. And I'm not suggesting that you yourself do it, but man, especially in ag lending, it's what makes the earned net worth work, and we go from there. All right, I'm going to go ahead and put the hands down. Thank you for that feedback. Let's do another poll question so you can compare to everybody else. What is your approach regarding debt coverage ratio? You have a guideline at the entity level, or a guideline at the global level, or you use it but don't have a guideline, or you do business loans but don't use DCR. That'll be interesting. Or it doesn't apply to you. Maybe you use debt to income or some other criteria. So I'm watching the numbers pile up as you are responding to this, and it actually makes me feel a little better that there are so many different answers. What this tells you, folks, is that whatever guideline works for you and is clearly communicated is something that you can use. The only time you can't be off the mark on guidelines is if it's actually a regulator or a legal issue, right? We don't get to discriminate, for example. But we do get to decide whether our guidelines for debt coverage ratio are at the entity or a global level. And so I see that most of you have a global level, but right behind you there's the entity level as well, which I find especially in commercial real estate, where regardless of the guarantors, you really want that project to sort of stand on its own, and the guarantors are really much more backup, or frankly in some cases just because the regulators are making you. Some of you have a DCR but don't have a guideline. That's interesting. I'm going to guess that you sort of have a range perhaps, and again that may vary for a variety of reasons. Nobody's doing it without a DCR. Did you notice that? So there you go. All right, so a couple guideline questions that will be in your handouts. What is our guideline for debt coverage ratio, and what compensating factors do we consider if it is low? And also for global analysis using debt coverage ratio, what do we use for family living expenses? And in fact, let's see what the answer for that one is. Poll question 7. If you are using family living expenses for debt coverage ratio, and you can select all that apply, what are the things that you consider? And I'm watching these numbers pile up again as you respond. Very interesting. And a few of you, it doesn't apply to you, and that means you're probably a personal lender doing debt to income ratio instead, but here's what I'd like to suggest. When you see I'm talking about something that is not common for your concern, ask yourself a question: how can I use this knowledge? Because sometimes you're looking at something, your guidelines aren't quite working, but because you know of another way to do it that's very commonly done, you can calculate it that way and then include that information in your write-up. So I'd encourage you to sort of expand your horizons when I'm talking about something that's not specific to you, and ask yourself the question, wow, how can I use that information? So I'm looking at the poll results. 80% of you are saying general guidelines or number in the home. So it's real common to have a starting number. Maybe it's $40,000 plus $1,000 per each dependent. It certainly may vary depending on the geographic region you're in. Then some of you also look at the lifestyle of the borrower, and certainly if they have really fancy things, I'll tend to look at the Schedule A, for example, and look at their charitable contributions. If I've got somebody who's doing a lot of that, well, that's something they're choosing to do, and that increases their family living. Only 3% of you are admitting to what it takes to make the loan work. I get a lot higher percentage of that when I'm actually out there doing training. Our ag lenders looking at whether they live on or off farm. So go ahead and close that poll, Billy. I would like to suggest you want a pretty decent guideline that gets you started at least. I like to have a range. So maybe for your geographic area, the range would be, it's typically between 40 and 50,000 or 30 and 40 or something like that, and then we go off range for a variety of reasons. I know some people prefer debt to income ratio instead of debt coverage ratio because then you don't have to guess on family living expenses. But what that does is you then don't get to take into consideration that this family is more frugal or this family is really spending their money, fast and loose. And I sort of like the ability to at least consider that. All right. And then let's focus in on the owner cash flow. Your goal is cash flow from the entity to the owner. You need to decide between what they're actually taking, K1 tells us that, or what the company can afford, the full return tells us that. And then, I think you already know the answer to this just based on what I said already. Do I ever use Schedule E page 2 taxable income or loss? Well, before I tell you my answer, I'm going to ask you. I have an answer. I promise to tell you, but let's find out from you. And by the way, before we leave this slide, guarantor analysis of a pass-through for a business. So business loan, but one of the guarantors has another pass-through. Notice the same questions, same questions. So this is where the business lenders and the personal lenders really come right together in looking at owner or guarantor cash flow from other pass-throughs. Let's put the poll up. When do you use taxable income from 1040 Schedule E page 2 for an owner guarantor? So either personal loan or they're a guarantor on some other business loan. It may be when the pass-through entity is not obligated, when the owner has a low percentage ownership, when it's on the passive side. You always do, you rarely do. And you can answer more than one. Oh, I just love always and never. I try not to use those words, but sometimes they do apply. We're almost there. Just get a few of you popping in more. All right, Billy, let's show the results. Biggest chunk said rarely or never. Rarely or never. I've got to say I'm in that group, and I'll explain why. 22% of you always do. I'm going to tell you why I think that's a bad idea. 2% consider whether it's on the passive side. That is one I would consider. So I would have answered rarely or never. I would have answered when it's on the passive left side. And let's see what my other choices. When the pass-through entity is not obligated, that would not impact my decision. When the owner has a low percentage ownership, would not typically impact my decision. So let me tell you what I would be thinking about. And actually, let me just back up. I think I'm going to back up a slide or two. Yeah. So here's the deal. The numbers on the back of Schedule E are taxable income, a share of taxable income from the pass-through entity, whether it's a 1065 or an 1120S. We don't use taxable income for cash flow. It isn't cash flow. And in fact, if you were willing to use taxable income for cash flow, we could make this a really short webinar and just say, use AGI. It's good. It'll work. Well, no, it won't, and you know it won't. So if AGI wouldn't work because it's not cash flow, it hasn't been adjusted for depreciation and debt and non-recurring and all those things, why in the heck would some portion of the bottom line of another return work? The answer is it doesn't. And if you're a lender who's trying to talk the analysts into using this number unless your guidelines say you can use it, just quit. Just quit that. Now, I did say I would consider if it's on the passive or non-passive side. If you've got a borrower with a whole bunch of K1s on the passive side of Schedule E, we'll look at this in a bit, and they're just investments, oil and gas, real estate, but they're not running the deal, well, then I might go with you and say, all right, fine. Small numbers, passive side, maybe. Anything on the non-passive side, I got to see something that tells me what they are taking or what the company can afford to pay them. So I use Schedule E page 2 as the roadmap to tell me what entities to pay attention to, but I very rarely use those numbers. And my clients don't. Most of my clients, their guidelines don't let them use it unless very small numbers, possibly low percentage ownership, but very low percentage, and for that reason they're not going to get something else. But boy, the difference between what's sitting on the back of E taxable and what the company actually paid them from the K1s and what the company can afford to pay them from the full 1065 can be dramatically different. So I think I answered one of the big questions that we had earlier. So let me go ahead and catch back up. Questions on deciding between actual and available cash flow for owner or guarantor analysis. I got Terry asking how many years of returns, and great question. I would actually, I recommend 3. I know for personal lending sometimes we go to, but we're talking complex borrowers. If you were doing just a straight wage earner kind of deal, you would not be on this webinar. So I'm pretty sure everybody on this webinar probably needs to be getting 3 to be able to tell whether it's an anomaly year. And frankly, if it's a continuing borrower, but you're new to them, they're not new to your financial institution, the first year I talked to them, and before I talked to them, I'd actually look at 5. So I could ask an updating question. I've got Samantha asking, what do you mean by personal loans? Is it no collateral? No, what I really mean, Samantha, is consumer loans. So this could be a car loan, it could be a boat loan, but it's really for personal use of the person you're lending to. You might have collateral, but it's not really to a business. And then, I did get feedback from Paul about the other question, and he said guidelines usually determine per complexity and amount. I'm absolutely in the game there. And I do see Mitch and some of the others are interested in the resource that I mentioned, and so I'm sure Billy will remind me what what resource that was. I think it's my green Legos, 6 ends and a map. Okay, great questions. Let's move on. Oh, and I do want to mention one other resource, because sometimes at the end of the call we get, time gets crunched, and in fact time is sort of crunching right now. I've created this 20 video series on pass-through entities, and they're short, 1 to 3 minutes on each one. If this is an area of confusion or concern for you or anybody else on your team, I encourage you to get it, and that's what the resources at the bottom is. And when you do that, you'll have a chance to sign up for my Ask Linda and some of these other resources, recordings of the previous SageWorks webinars and the resources we provided there. So easy way to get the additional resources that I have available for you. Now I want to walk you through owner actual cash flow, and so what I'm about to do is take you on a walk with me as I look at these returns. I am not in training mode right now because this is a 60-minute webinar and we're 46 minutes in. This is a walkthrough, but walk through with me, and if there's things that you need to pause about, since you can't pause on a webinar, that's what the recording is for. I already gave you the figures you need for 1065 K1. If it is an 1120 SK1, they have a distributions figure, although it's on a line called, let's see, adjustments to, is it shareholder, items that affect shareholder basis. That's what it's called. It's not called distribution. So part of the challenge sometimes is you look at these things, you go, where's the money? Well, they're calling it something else. Now, repayment of loans, repayment on loans from shareholders, it is the same place, line 16. It is a code of E. A lot of you don't use that, and that's okay. I'm not trying to talk you into anything here. But if it's 100% owner, what is the difference between they're getting a repayment on a loan and then they get that paid off and they take the same number as distributions? So if I've got 3 years K1s, and if I add distributions and repayments on loans, the combined dollar is consistent, and it is 100% owner, I'm probably going to either use it or consider it in my write-up. So when you use this, if you're lending to the owner of a pass-through, or you're calculating cash flow to a guarantor from another pass-through entity. Poll question. You're considering cash flow from the business, and in addition to everything else, that business pays rents to the owner, or makes loans to the owner, or repays a loan from the owner, or pays on a note payable that the spouse lent to your business, the business, or distributions and guaranteed payments. So give me a quick sense of what you would consider using for personal cash flow from a business I control. And the numbers are really clicking up here. That's great. We all think distributions and guaranteed payments are a good idea. I agree. And let's just see what else we got. Good enough. Go ahead and close the poll, Billy. And we're all on distributions and guaranteed payments. Everybody's pretty much on rents paid to the owner. I'm assuming you have signed leases and there's consistency and such. Fewer, let's see, next is repayment of a loan from the owner. And again, it's only 43%, and I would just have to consider the circumstances. Loans made to the owner are a little bit trickier, but if you look at the overall picture and the dollar amount is consistent, not real sure that it makes a big difference. What's interesting to me is way fewer of you went for payment on a note payable to the spouse. Now, maybe that's because you don't always count spouse, but if you were counting overall cash flow from that couple, I would definitely be on the notes payable if it's continuing. I don't care whether it's a related entity or not. If I have evidence it's continuing, then it is cash flow from my perspective. Okay, go ahead and close that poll. So 2 more guideline questions. They're in your handouts when you pull them down. Sorry, 1 more guideline question. I want to show you those 3 numbers that I mentioned on a K1 from a 1065. Withdrawals, guaranteed payments, capital contributed. So this person has $55,910 in cash flow. That's the checkbook. That's what did happen. If it is an S corporation, you got a couple things you can look at. One is do you have a final K1? That's actually on either of the K1s, 1120S or 1065. It also tells you their percentage ownership. And then you have to go a little bit further down. Whoops, I actually didn't mean to do that spot. Well, we're okay. Notice line 16, items affecting shareholder basis. There's a C, ignore that, but there's your D, 13,914. So that's the number that Ben took from this particular entity. So if that's what you care about, it's easy. Now let me back up. The mortgage lenders, you have a little bit of a challenge because you got to do it the way Fannie Mae or whoever you're selling to does it. So there's a difference between performing loans and qualifying loans. Now I do have a place for questions here, but I'm actually going to move on to be sure we get through the rest of this. Here is your partnership return. And I put in the income statement, which is just an income statement using tax rules. One of the differences on the 1065 is they've got guaranteed payments to partners instead of wages to shareholders. So that's a little different terminology. And guaranteed payments typically is a payment that's agreed to. So you got several owners, one works full-time, the other works part-time. They might pay themselves a compensation, maybe based on hourly, for the hours worked, and then split it, say 50-50. So guaranteed payments are simply when there are different payments to the various partners, typically for time spent, and it's most closely associated with compensation to owners. Now, if there's no reason that a 50-50 split doesn't work, then there'd be no guaranteed payments, and it would all show up in distributions. Bottom line, $65,961. So, and there's your guaranteed payment. So these owners are paying both on their share of the bottom line and the guaranteed payments they took. Here's a typical bottoms-up analysis. We start with the bottom line, add back interest, add back depreciation, make a few other adjustments. Cash flow available to pay debt and distribute to the owners, $68,601. And some of you do a top-down instead. So you put in revenue, you put in expenses maybe in detail, but then you eventually still add back interest, still add back depreciation, come up with the same number. So variation there. Now I moved this up out of the way to show you that once you get cash flow available to pay debt, if you're looking at the entity, we got some choices. If I want to know what's left to pay debt, though, I've got to find out what did they pay the owners. So if you're doing entity level, debt coverage or debt margin, you've got to back off what's being paid out to the owners. We're not going global yet. We're just looking at the company. So this company has $16,781 available to pay debt, and that debt number comes from borrower records or something else. The margin, $2,330, the debt coverage ratio, 1.17, and I'm guessing that 1.17 for many of you is a little bit small, although I'm looking, Samantha says that they're looking for 1.15, but that would be including a 15% for living expenses. So that's a global number, not an entity number. Poll question. Let's find out what your debt coverage ratio choices are. $1.25 or less, 1.25 or more. And then, again, you can answer more than one of these. So let me know what it depends on. What would be your compensating factors as well? All right, Billy, go ahead and close that poll. So 1.2, more than 1.25, unless you're going for that. By the way, it may depend on whether you're doing commercial real estate, small business, etc. And then compensating factors depend on several possibilities. Go ahead and close the poll, Billy. So 2 more guideline items that your handouts will include. There was your S-Corp front page, and I just made it smaller so we can just look at the income statement section. Again, bottoms-up analysis, very similar to what we saw before. So in this case, this entity has $10,325, which is better than the negative $22,870 that you started with. Oh, let me make a point here. You got to suspend judgment when you see negative bottom lines. As soon as you draw a conclusion, your brain actively seeks support for the conclusion you've already drawn. So get in the habit of suspending judgment until you've actually done the work. Now this one has a big bad debts in here, so maybe that was a problem just 1 year, and we could look at the other years and it would be a little bit better. So here is our global analysis for B&J Floors. They're the ones that have the $10,325. And then I would go start my debt list. And we didn't know that before, but oh, $26,000 in debt. They have a little problem, don't they? At an entity level, they're negative. But when I bring Ben in, assuming we're just going to use Ben, let's assume that for a moment. He's got 100,000 wages. I told you it was pretty straightforward. We need to put his personal debt in. We need to do something about family living. We talked about that. Most of you subtract taxes as well. So $44,325 available, and the combined debt is $52,604. So if I've done my math right, this doesn't work, does it? B&J Floors was in too much trouble for Ben's personal side to save it. At which point, you know, some of us were going to put Jan in too, and maybe Jan's better off and we could get Jan in and her debt payments, and maybe that would turn this thing around. Is there ever a point where you're having to work so hard to turn it around that you have to go, maybe not? Here's the other piece, and this is where I'm probably going to pretty much wrap it up. I have way more in your handouts for details, and I'm able to stay a little bit longer, but we only have an hour planned for the webinar. And I did know the handouts would have more than we'd have time to cover in the webinar. But here's my problem with this. If I only count Ben, but the company actually made an additional $7,000 distribution to somebody else, then your debt coverage ratio can't be right because you're not counting against the business those distributions they actually paid out. So if you're not requiring Janner's Act to guarantee, I think you need to subtract the extra $7,000 from company cash flow somewhere. I would put it under other expenses on my own worksheet. So this is a question asked earlier. When you don't pull all the guarantors, be sure that you are counting against the business somewhere, those distributions that aren't going to the guarantor that you are using. So let's see what I want to skip to at this point. I haven't been keeping up in my own handouts. This is number 64 in our slides. No, actually, let me just finish up. So if we're doing Jan and Dan, somewhat similar, except now we've got the global for B&J Floors, only 25% of it. Let me say some of you would count 100% of that debt if you didn't know anything about the other owners. I did odds and ends on the side, and that one, there's actually a positive $50,000, and then she's got another $110,000 from other things. So if we finish this thing off, this one is in much better shape. 2.43 debt coverage. By the way, some of you do debt to income instead. That's 27%. That would be a nice number as well. So in your handouts, you got a couple more guideline questions related to the non-obligated entity. And then at the end, I'm going to just show you this is what this one partner got paid 24,000, or had put in their tax return $24,999. That's what's on Schedule E. I don't use it. I don't use the number that comes to the front page from Schedule E. I just don't. I use it as my roadmap. This is her, $38,594. So this is what was on her tax return. This is what she took home, and this is what we think the company can pay. And you need to decide, based on your guidelines, based on your common sense, and based on your judgment. That's it. We have a few other slides that are in your handouts that have a lot of detail, and I'm not going to spend time on the webinar for them, but it ties everything up in a nice little bow. So you definitely need to pull those handouts down so that you can get that last piece that puts it all together. Let me pass it back to Billy.
Thanks, Linda. I really appreciate you walking us through that. Certainly was insightful, and all the poll questions were great insight. We did want to close out with two final poll questions. And obviously we are keeping the webinar today strictly educational, but did want to give those on the call an opportunity to raise their hands, so to speak, to learn more about both how SageWorks can help and how Linda Keith CPA can help. So I'm going to go and ahead and launch up the first poll question. So SageWorks has a credit analysis solution that helps with global cash flow, double counting, etc. But we actually recently launched a new solution called SageWorks Workflow that helps define and manage credit processes so they are more effective and efficient. So I want to give you an opportunity to indicate interest in learning more about SageWorks Workflow. I'm going to go ahead and launch up that poll question. Leave it open for just 15 seconds if you'd like to indicate your interest there about learning more about that new solution. Really appreciate it. 50% of you already voted. We'll leave it open for just 10 more seconds here. All right, thank you very much. Going to go ahead and close that down. And then we're going to go ahead and ask a similar question. If you'd like to learn more about how Linda Keith CPA can help you, whether it be through different training resources, etc., I'm going to go ahead and launch up a poll question here so she can follow up accordingly with that. So we've got yes soon, in Q2, after Q2, or already a client, or maybe just not at this time, but certainly appreciated the webinar. We've got almost 60% of you voted, so again, we'll leave that open for just another 10 seconds or so.
And Billy, while you're doing that, I'm also answering some of the individual questions. So some folks are still getting questions answered on the question side.
Great. And Linda, too, if you haven't pulled it out, you can pull the questions box out of the GoToWebinar panel so you can see things a bit easier.
Oh, that's lovely. That would have been good to do, huh?
So go ahead and close that down. Linda, if you want to flip to the final slide here, I'll just highlight it briefly and then turn it over to you to kind of answer any questions that you see pertinent. So obviously, Linda Keith's contact information is up there. I encourage you to reach out to her directly. Also, you see the various websites there and some of the available resources. And just a reminder before I turn it back over to Linda, so we got a variety of questions in during today's webinar. We're going to take a few minutes here. I know we're over our hour time frame, so those of you that are able to stick around for a few minutes, we'll take the time to answer those. But we will plan to follow up with you via email following today's presentation if your question does not get answered on the call. And then final reminder is you will receive an email following today's presentation with a link to the slides and recording so that, again, per Linda's point, you can go back at your own pace, review the material, so you can maybe get a little deeper understanding of it. So with that said, I will turn it over to you, Linda.
Great. And the one thing I want to hit at the end, we actually have an opportunity right now. We're looking for only 5 financial institutions. I'm launching something called the Lenders Academy. It is a complete, 4-month training that covers credit and sales, and it's under development. And there's an opportunity to become a beta partner and partner with us as we do it and get in on the ground floor. It's very awesome. And so if you go to thelendersacademy.com, and you'll see that opportunity. And I know there's some people on the call that I really hope step up because I already work with some of you. But that's just something brand new, and it's out of the box except that it's completely customizable, and then you use it and train it. So that's one of the resources available in addition to the others. I really enjoyed being here. It was an overview, not a training. Slow it down through the replay if that's what you need. And thank you, Billy, again for letting me partner with SageWorks on an opportunity for people to learn how to say yes to good loans.
Thanks, Linda, and thanks again, everyone, for joining us. Have a great rest of your day and a great weekend. Thank you.